Chartmaster says it's time to take some chips off the table for one of these dinosaur tech giants, Carter Worth of Worth Charting, who certainly takes notes. He's with us to break it all down. Carter.
Well, you know, the way to do it, of course, you just take notes on your good ones. The bad ones, you don't keep those notes. In any event, look, I'm all for Oracle, Cisco. IBM, I think, is a different circumstance. Those are stocks that have been acting well for the better part of 2 years, that have given back some. IBM has been really a dog, and this sharp rally leaves it at a difficult level. Let's look at a chart or two. So the first one is IBM over the past decade or thereabouts, and no judgments, lines drawn. Now look at the exact same chart with some lines drawn, with a judgment rendered. We have gone precisely to a downtrend line that's been in effect since the peak that you all were talking about in 2011, right? The stock was 206. It hit a low, a COVID low of 86, and now it's rallied a lot up to 138. So next chart, this is the third of four. This is even longer term. You have a fairly clear level here, which is to say, after a move like this to a level of overhead supply, taking some chips off the table as a long-only player, I think makes sense. We're writing calls or some other measures taken. Short selling, I'd initiate here, and if and as it moves above the downtrend line, then you've got to acknowledge error and close the short. Final chart, and this is the structural circumstance that also is in effect. A two-panel, that's IBM going back to 1967, and on the bottom is relative performance to the S&P. We are basically approaching sort of the 70-year relative low. That was done in 1994. Let's let it at least try to show us some relative performance before embracing it structurally. Right now, tactically, it's moved to a difficult level, and I think it's a better sale than a buy.
Carter, while we have you, what's your take on what's gone on in the markets? Are there any stocks or sectors that have had damage done?
Well, a lot of damage done across the board. I guess what will be the most interesting is how much damage does tech have to endure before it becomes interesting? And the real question is this: does it really matter that the cost of 10-year money is 1.2 or 1.8, 1.6 or 1.7, 1.5 or 1.9? It does not. If you're really doing 3 to 5 year DCF work and trying to invest in a growth enterprise that's a disruptor and a market share gainer, the cost of 10-year money at 1.8 is absolutely irrelevant.
All right. Carter, thank you. Carter Braxton Worth of Worth Charting. Carter speaks truth. He's very rational, as is Carter always, Brian Kelly. And yet the markets don't act that way. 1.8 would be a big deal to these markets. That would mean the highest level on the 10-year yield since, I don't know, at least, you know, back a year or so. So what do you say to Carter?
Well, so Carter's very rational. I think Carter made a really good point saying if you're doing 3 to 5 year discounted cash flows or any type of valuation metric that you're looking out 3 to 5 years, it is irrelevant whether it's 1.6 or 1.8. But here's the reality of what goes on in hedge funds and mutual funds and whatnot, is that if you underperform for 3 months, you're out of a job. So it's more of a career risk thing than the actual fundamentals behind it. And that's what we're going through right now. So, you know, for me, if you're looking 5 years down the road, you know, close your eyes and don't worry about it. But in the meantime, if we go 1.8 or 2, that will surely slow the economy, and that'll hurt earnings, and that'll create stocks going lower. So, you know, I just think it's a matter of time frame when you're talking about it. We're traders on this show. This is fast money. Shorter time frames matter.